We are now recording.
All right, thank you. All right, hi everyone. My name is Laura Ordez, and I'd like to thank you guys all for coming to the event. This is our first 2021 speaker series hosted by Flex. For those of you who do not know, Flex does stand for the Future Leaders and Entrepreneurs Exchange, and we aim to aid in the development of the area's young professionals. We're very pleased to welcome Tom Kadylak from Northwest Investment Services and Alex Gunter from Raymond James, who's also a fellow Flex member. They'll be talking to us about how to invest in our future. Just a couple quick points before we do get started. First, we will be recording the presentation, which will be uploaded to YouTube. The link to the recording will be posted on social media and emailed to everybody on the participants list today. Second, please keep yourselves muted in an effort to eliminate any background noise. And lastly, please direct all questions to the Zoom chat, and we'll make sure to address each one after the presentation. We also want to make sure that all questions are kept professional. So if we're ready and there's no questions or comments to start us off, we can go ahead and get started.
Okay. All right, so yeah, we're just gonna, I guess, do a little bit of introduction here. So my name's Alex Gunter. I am a financial advisor with Raymond James, specifically Gunter Financial Group, just out of Oil City. My dad and I are partners there at the firm, and we've been there, I think, for about 14 years. So we've got a nice little practice set up and work with a lot of great people in the area. We specialize in retirement planning, basically from beginning to end. We do a little bit of estate planning as well, and just your general investing needs. So, obviously this isn't a sales pitch, but if you ever need anything, please don't hesitate to reach out, even just general questions. We love to help out if we can. Tom, you want to give yourself your little spiel?
Sure. Yeah, my name is Tom Kadylak. I was born and raised in the Franklin area. I'm a graduate of Slippery Rock University, but more recently, I'm a financial advisor with Northwest Investment Services. I joined Northwest about 3 years ago, and yeah, I appreciate the invitation to speak with everybody today.
All right. Yep. And yeah, thank you all for coming and giving us the opportunity to share some of our knowledge with you around investing and how it can benefit you. Specifically, what we're going to be doing is kind of hitting on 7 major habits of financially successful people. Basically just some tips and little tidbits of good information on how you can kind of set yourself up to be ahead of the game down the road. So Laura, if you want to go ahead and hit the next slide button, we'll go ahead and get started. So first off, I mean, I'm not sure the age range on this call, but investing in yourself, from the beginning is a great way to put yourself in a position to, make more money. One of the most beneficial things that a person can do from the start is just, getting a higher education, college education, trade school, something of that sort to kind of set yourself above the rest and put yourself in a position where you can, be in a good paying job. Just some stats, obviously this kind of comes with a cost. But, if you're looking here, you can kind of see the different tiers. Less than high school, you're going to be making your minimum wage. And then you can see as it increases and you get up into the bachelor's degree or higher, obviously that's just a kind of a general picture and illustration of what you could be at. Obviously you can make more than that depending on what kind of profession you are in. Laura, if you want to go ahead and hit the next one. The next thing I want to talk about really is just the cost that's associated with this. Obviously when you go to college, you're going to incur some student debt, unless you're lucky enough to have grandparents that have saved for you or parents that have saved for you and kind of set you up to be debt free after school. You may incur some expenses, after college. Obviously there are ways to make this a more affordable experience. Just to touch on a few, you can apply for grants and scholarships. You can, work while you're in school and pay as you go. That's something that my wife did while she was in nursing school. She paid as she went along, and it panned out for us in the long run. We're, debt free in regards to school loans. So it's a pretty awesome feeling. And then also there's the option to apply for financial aid if possible. I know that a lot of times, I believe it's the parents' income that can play into whether or not you're eligible for that. But that's another option that you can look into. Paying off your student debt, on average, they give you kind of a rough estimate there. It's on average about $382 a month And it can take about 18 and a half years to pay off, and that's kind of accounting for interest, and inflation as time goes on. How can you pay the debt off sooner? Just like your mortgage, if you pay more into your principal, you're going to pay that off sooner. If you have extra money, you've worked harder, and you're able to add a little bit more to the principal of your payment each month, you're going to pay down that student loan quicker. And then you can also reduce the cost of living in your early years after college. Living with your parents, as lame as it may seem, is not a bad idea. It saves you a ton of money, and you're able to, if nothing else, pay off your student debt before actually entering the real world, if you will. So how's it pay off? Obviously, the payoff is you're going to have a college degree and you're potentially going to get a better job. According to Forbes, a bachelor's degree recipient working full-time can on average make about $24,000 higher than those with a high school education only. Obviously this is just just to paint a picture. But it's definitely something that can kind of set you up for a successful future. Obviously there are people out there, there's a quote right there on the screen from Mark Cuban, who's a self-made billionaire. There are people out there that dropped out of college, dropped out of high school, and they've still made it through. Those are rarities. And if you're one of those people, good for you. But college education can definitely be something that can set you up for benefits outside of obviously making more money. You can have the ability to get a job that offers a retirement plan. You can get a job that has the potential to provide health insurance and and not have to potentially depend on public benefits, as some people do. So that's, I guess, in regards to habit one, that's just some information around college. And again, I don't know if everybody's already been through college or if we have some people that are in that phase or what the case might be, but just some ideas there. So Tom, go ahead, take it away for habit number 2, sir.
All right, thank you, Alex. So borrow responsibly. Basically, only borrow what you can afford, only if you have to, and at the lowest rates available. So Alex talked about borrowing for college in a responsible way, but that same cost benefit analysis can be applied to borrowing for any large purchase, such as a home. So this slide breaks down what might be considered bad debt, such as credit card debt, personal loans, or even car loans. What they have in common is usually higher interest rates, no lasting or very little value, and perhaps they could be prevented with better planning. Now, good debt, on the other hand, is going to offer lower interest rates, help increase your net worth, and often even has tax advantages like student loans or mortgage deductions. So, next slide. Okay, a big part of borrowing, though, is establishing and maintaining a high credit score. Pay your bills and debts on time, and check your credit scores periodically for errors. In the hypothetical example on this slide, you can see how significant a credit score can impact the monthly car payment, where a person with good credit saves about $130 a month versus someone with a poor credit history. So this one was a short section, so I'm sending it right back to Alex.
All right, thanks, Tom. So habit number 3, I really like this one because it's something that I do myself. Giving every dollar a job. As simple and stupid as that sound, it can be very hard because the world tempts you with all kinds of different stuff. Amazon makes it very easy to shop and spend way too much of your money. So budgeting and giving each dollar that you earn a job gives you the opportunity to avoid that and spending more than what you actually have, which unfortunately a lot of people do. It can basically, creating a budget can simplify your life. And as Tom had mentioned in the last section there, having bad debt can be avoided by budgeting and planning accordingly. It creates structure within your wallet. It allows you to establish and achieve any financial goals you might have, whether that be early retirement, being able to buy a house in cash, whatever the case might be. It allows you to get closer to those goals in a more timely fashion. And then, one simple thing is that it ensures that all your bills are paid on time. Tom hit on credit scores last time. If you have a budget set up where you know where your money's going, you know when it's going out, you're not going to have to worry about late fees, and it can protect your credit score in that way. Budgeting can also help you to see the long-term picture. Just a simple quote here, according to Career Builder, 80% of the US workers live paycheck to paycheck, unfortunately. And, giving every dollar a job can ensure that you're allocating money to not only your employer retirement, but also potentially additional savings. If you're putting money aside in additional savings, you're just adding to the ability to potentially have a little bit more financial freedom. So that's the bottom line. Saving money equals financial freedom down the road. Go ahead to the next slide, Laura. I think I already hit on that one, sorry. And I think the next one's Tom, so.
Okay. Well, this one is start saving for retirement early. And I know, speaking to a group of young professionals, it might seem like a ways away, but I think this one is valuable. So in this slide, just take a moment to see the impact of retirement savings for these 4 examples, in which the only variable is when they started saving. So habit number 4 is to start saving early for retirement, usually in an employer-sponsored plan like a 401k. But when you're young, you have a long investment time horizon for your money to compound and grow. So even if you don't have $12,000 a year to contribute, and a lot of us don't, you can see it pays off to give your money more time to work. So the message for this slide is simple: start investing early, even if it's a small amount. Next slide. So this slide's a simple one, but it features a big benefit of 401ks, the employer match, or basically free money. Just a quick note, the 401k is probably the most common retirement savings plan nowadays, but there are other similar retirement savings plans that offer similar benefits. So if you happen to have an employer that has a 403b or a thrift savings plan or a simple IRA, don't feel left out. Those are very comparable and great resources to help you, save for retirement. But with a 401k plan, you can invest money pre-tax, so money you haven't paid income taxes on, essentially meaning there's more money to invest. And an even better perk is that often employers offer some type of a matching incentive. So one example might be 100% match up to 4%, meaning if you put in 4%, your employer is going to put in 4%, you'll have a total of 8. You've essentially already doubled your money. Now, a general rule for retirement savings is to save about 15% of your earnings for retirement. That probably seems like a lot to some people, but that does include your employer match. If that isn't feasible, I would encourage anyone to try at the very least to contribute up to the amount that the employer offers a matching incentive. And one final note I wanted to add before I hand it back to Alex is Roth 401ks are becoming more common, where your 401k offers you the option of a traditional contribution or a Roth 401k contribution. Here, the money is funded a little bit differently. It's funded with after-tax money, but it still grows tax deferred, and it's not subject to taxes in retirement. So a Roth may make sense for young professionals in a low tax bracket earlier in their career, because down the road, you'll likely get promotions throughout your career, make more money, and then elevate yourself into a higher tax bracket. But early in life, it often makes sense to consider a Roth. So that is all I have, Alex. I'll give it back to you for habit 5.
Thanks, sir. So habit number 5 is automating your savings. Everybody's heard the old adage of paying yourself first. This is basically what it looks like. And it ties back into the 401k of habit number 4 and the, giving every dollar a job of habit number 3. The nice part about this little presentation is everything ties together. And it's basically in the end creating financial freedom for you. So, obviously you receive your paycheck. You're automatically giving money to a retirement plan through your 401k or whatever type of retirement plan that your employer provides, whether it be a simple IRA, 401k, whatever the case might be. If you're an educator or you work in a medical field, you might be in a 403b, which is another type of retirement account. the idea with this is, it allows you to do it and it puts it out of sight and out of mind, which is something I like to say a lot, because when it's out of sight and out of mind, you don't know it's there. You don't, and it's working for you in your favor. So, that's the first major avenue. Second one is setting up automatic payments to maybe go from a checking once you've received your paycheck directly into a savings. Whether that be $100 a month or $500 a month, whatever you're able to afford. What that allows you to do is a couple of different things. It allows you to create an emergency fund, which is something we like to stress in our industry. A lot of people, get $250 set aside and they want to invest it all. And unfortunately, we encourage you to make sure that you have emergency funds, because if you put stuff into investments outside of your 401k, you might get it into something that's tied up or has the potential to have risk associated with it, where you might lose the money. So what that automated savings does is it gives you the opportunity to do that without even thinking about it. You can prioritize your debts with higher interest rates. So if you have a credit card with a 24% interest rate, set up an automatic payment to go to that to pay that off. Even if it's $50 over your minimum, that's better than, just paying the minimum and then end up paying interest on it at the end of the month. And thirdly is saving for goals. If you want to buy a new car, you want to save up for a down payment on your home, doing this automatically, again, just takes the burden off of you and it allows it to do it on its own. And it makes it much easier on you. So go ahead to the next slide, Laura. And this is, I thought this was a great slide. This is just this is a theoretical illustration here of what it could look like potentially if you were contributing $500 a month for 40 years into some sort of savings account that potentially offered an annual 6% return, which, is a pretty average return on your investment. You can see there the amount that they've contributed is $240,000. But what you're earning is much, much more because of that interest. And, it's something a lot of people aren't aware of is investing your money into something that gives you some sort of return, can give you that compound interest that basically your money's working for you at that point, and you're not having to worry about, pinching pennies to save. It's doing the work for you here. But it also kind of illustrates just the difference that it can have if you miss 2 payments a year. You miss out on $1,000 each year. That, over 40 years creates a $40,000 difference, and you can see the dramatic difference in the compounded interest. It's just shy of $100,000 less. So this just kind of helps to reinforce. I'm not sure what habit it was, but starting early, this is why. You start early, you have the time to invest and put money away. This will be what happens in the long run. So go ahead to the next slide. Tom, take it away on number 6, sir.
Okay. Yeah, so adopting a growth mindset, basically it's making money in your sleep. And we've hinted on this in previous habits, but it's also known as compound returns. So, trading time for money can get you far, which is what you do for employment, right? But to go further, you have to put money to work by investing. So earning returns on the money you invested and then earning returns on those returns. Over time, the snowball effect, becomes more evident as the account gains momentum. So basically, one common financial rule that I wanted to leave you guys with is the rule of 72, which is when your rate of return times your duration equals 72, you've doubled your money. So just a quick example, if you get an 8% return on a given investment every year, you would expect to double after 9 years. Okay, and that's something you can apply to just about anything. That one was the shortest section we had, Alex. So
I think it was. That's just a one-trick pony there, but that's fine. And this is something that you could talk about for hours, but it's short and sweet. Tom, I like that 72 rule. That's a great one to live by for sure. Or you go ahead to the next slide. This one, basically this kind of breaks down investing for you. There's a lot of different knowledge bases out there, some better than others, some very false, as I'm sure Tom can attest to, and some that you want to steer clear of for sure. But there are other, sources out there that are very, very good. For instance, one that, I've used during my studies when I first got into this field was Investopedia. It tells you everything from beginning to end about how to invest, what it entails, down to the fine details. So just, keep in mind that, if you're looking for financial advice, don't be afraid to reach out to a financial professional such as Tom or myself. A lot of times those individuals will give you some sort of consultation for free just to help you out, because this is such an intricate and finicky field. And, this is your livelihood that you're dealing with. So, just a couple, I guess, just to break it down for you simply and kind of give you some fine details on what investing looks like. So when it comes down to it, you take your money, let's say $50,000, and you're putting it into a certain account. You have the option to invest in different things. So you have your asset allocation, which can be your investment mix. Just for example, if you are super conservative, you're afraid of losing your money, you can be in a very low risk asset allocation. If you're on the other end of the spectrum and you want to take all the risk in the world and get invested in every risky stock there is, you can go into a more high risk and intense asset allocation, I guess you could say. There's different asset classes, just to name a few: stocks, bonds, cash equivalents. And then the key to all this is diversification. So taking and mixing those, for instance, those three: stocks, bonds, and cash, mixing them in a variety of ways to create your asset allocation and, that we're able to manage in your portfolio. Go ahead to the next slide there, Laura. So just to kind of give you, the difference between two of the major ones that a lot of people invest in: stocks and bonds. Stocks, if you own if you own Apple stock, you have a share of that company. Some stocks provide dividends, some don't. Just depends on what type of a company that is, in regards to the stock that you're buying. Is there a return guarantee on a stock? Absolutely not. That stock could go to zero, or it could go to infinity if it wanted to. I guess, you've seen that with Bitcoin. It kind of is a wild card. So that's just an example of a stock. Bonds, basically what that is you're loaning money to a company, and they're guaranteeing that they'll pay it back to you within a certain amount of time with interest. So yes, you'll get interest in return. And yes, there is a return guarantee. Unless that company goes belly up, you are going to get your money back. So those are just a couple examples of, two of the major types of investments that you could get into, different vessels, I guess you could say. Go ahead to the next slide, Laura. So you can see here, just the risk versus potential return. Just to put it simply, the more risk that you take, the more return you have the potential to receive. But on the other end of the spectrum, you also have the potential to receive no return. So, it's kind of a risky play. If you're into that, it can pay you out well. But if you are not, then, there are other options out there. Bonds, as you can see, they kind of fall in the middle of the road. Stocks, you may receive, for instance, in this illustration, you could potentially receive a 10.22% on your investment. Bonds, you could potentially receive somewhere around a 6%. Nowadays, you can't find anything around 1%, but that's a whole different topic, and a much longer conversation. And then your cash alternatives, those are going to be your most secure. Basically, these are things that are, if not the same, very similar to having cash in your pocket and or in a safe, and knowing that it's there and it's safe. Nowadays, since COVID happened, unfortunately, the return on this kind of an investment is very minimal. But again, it's very, very safe, so you don't have to worry about your money. So this illustration may or may not be super accurate, but it gives you an idea of where things lie along the spectrum. Go ahead to the next one, Laura. So this is kind of getting a little bit deeper into the different types of investments that you have out there. To try to make it easy for you to understand here. A mutual fund, the way that we like to describe it is if you think about an umbrella, that's your mutual fund. And then underneath of that mutual fund, you have other umbrellas where you may have smaller mutual funds or just other stocks. So Apple, Facebook, stuff like that. But basically what that mutual fund allows you to do is diversify your money, pull your money together into quite a few different companies, depending on the size of the mutual fund. And it allows you to diversify the risk across that mutual fund. So that way all of your eggs are not in one basket. An index fund is very similar. It just, the way that this one is set up is it's funded with holdings or positions or stocks that track a particular market index, such as the S&P 500. I don't know how well versed anybody is, but the S&P 500 is a benchmark that we use to track how the market's doing, certain sectors and industries are doing within the markets, and it gives us an idea of where things are heading. So an index fund is one way to kind of track that S&P 500 benchmark and perform right in line with that. A target date fund is something that more than likely you're going to see in your 401k. A lot of times people don't really look and see what they have in their 401k investment wise. A lot of times they just sign up for it and they start putting money into it, and that's the end of it. And that's great. Again, out of sight, out of mind. But a target date fund, the way that it's set up is, as it says there, it's an all-in-one investment, and it rebalances as you move toward your retirement date or your target date. So in the beginning, you might have an allocation that's more heavy on the equity or stock side of things. You might be in the market a little bit more, so it might be a little bit more, I guess, risky of a portfolio. But as you move into your later years as an employee, that target date fund is going to rebalance, and it's going to switch things to a more conservative approach. So you may end up with a 50-50 versus a 90-10 portfolio. And by what I mean there is 90% in the market, 10% safe, or 50% in the market, 50% safe. So those are just some different funds. So mutual funds, index funds, target date funds are all types of different, I guess, index funds and target date funds are types of mutual funds, but they're just some different options that are out there. I think that might be the last slide. I think we kind of cruised through that pretty quick. Yeah, anybody have any questions? If we talk too fast and you want us to repeat anything, let us know. I know I tend to do that, so.
Thank you, Alex and Tom. I'm not quite sure. Kat, do you see any questions in the chat?
I don't see any questions in the chat, but if anybody has them, feel free to do that while I ask a quick question. So Tom, could you go back to that? Was it the rule of 72 or could you just review that one more time for me?
Yeah, that wasn't on a slide. There's a general financial rule. It's just a quick calculation, and it's called the rule of 72. And it's basically, you would take whatever your return on the investment is. So an example I had, I think I used an 8% return, which is hypothetical. If you want to figure out how long it's going to take to get to the point where you've doubled your money, you multiply it out times the duration. So 8% return times 9 years equals 72. If you're getting a 9% return, it would only take 8 years.
Okay, thank you.
Mm-hmm.
I also have a quick question. So you were talking about budgeting. Is there usually a set, whenever I do budgeting, I do, a budget, a line item for groceries, a line item for gas and stuff like that. So is there a particular percentage that, there's a certain percent that you should put towards savings, a certain percent that you should put towards free money or just fun money that you're able to, purchase what you want for that pay period, a certain amount that, you put into just your general life, which would be groceries and stuff like that. Is there, would the best way to budget to be break it down for like savings and lifestyle, stuff like that?
Yeah, and the one thing that we always touch on when we talk about that kind of thing is it really comes down to your lifestyle and I guess how much you live under your means or over your means. And by that, I mean, do you live a lavish lifestyle and you like to buy fancy things, or are you somebody that goes hiking every weekend and doesn't really do too awful much? I don't think there's a specific amount. I mean, if you're putting into a retirement plan, that's more of I guess a percentage you want to put aside. But when it comes to after that, you want to put in what's comfortable for you. You don't want to strap yourself too much where you can't afford to pay your bills, or if you for some reason eat through your groceries too fast, you can't afford to go to a grocery store without pulling money out of your savings. That's where you kind of know where you're at. So one thing that I tell people to do is potentially to just start small. Do it in increments. Maybe start with $50 every paycheck. See if that's something that you can manage. If it is and you have money left over, maybe then the next time around bump it up to 75 and just keep going from there. But any bit that you put aside is better than nothing, Laura. I think that's definitely the best point there is something is better than nothing.
Okay, we had another question come in through the chat. The question was, you touched on a bit of alternatives to 401ks, but can you talk a bit more on options that are out there for folks whose employers don't offer retirement benefits? I would say the most popular would be an individual retirement account or an IRA, which anybody that does not have a workplace plan offered to them can start. And if you're under the age of 50, you can contribute up to $6,000 a year into an IRA. And that will be very similar to just any other investment accounts that we discussed. The big thing is you forego that benefit of a company match, but that's a great resource. That's
right.
What I do.
Yeah, absolutely. And I think it depends on your situation too. I mean, there's a couple different options. You have your traditional IRAs and you have your Roth IRAs. Jared, I'm not sure if you own your own company or anything like that, but there's other options out there for people that may own a small business. Simple IRAs. You can also open a SEP IRA if you're the only employee. If you're just a one-man show, that's another option for you as well. But Tom definitely hit the nail on the head with just your individual retirement accounts is the way to go. And I would encourage that for anybody that doesn't have an employer sponsor plan for sure.
All right. Are there any other questions?
I've got another question. You know me.
Okay.
So you talked a little bit about diversifying, but was that within, within one account, or are there benefits to having multiple? Maybe, you have a 401k with an employer, but does it make sense to open your own IRA as well? Or is it better to have all your money in one pot for the compound interest? Or
Well, I mean, if you're maxing out your contributions on a 401k and you still have a bunch of money left over, and you want to save additional money, there's nothing wrong with putting into an IRA or a Roth IRA. If you can do that, kudos to you. I guess what I was talking about in diversification, you can diversify your accounts. Obviously there are tax benefits as well with certain types of accounts. So for instance, if you have a 401k and you put money into a traditional IRA as well, you're able to actually take a tax deduction on that money because that's after-tax dollars that went into an account that eventually you'll have to pay taxes on to take the money out of. So those are things to consider if that's something you're looking for, in your financial picture. But diversification, I guess, within your portfolios is important as well. There are people out there that like to pick one stock and ride it out and try to time the market, but that's risky. So being able to diversify your portfolio can help to spread out or not necessarily eliminate the risk, because that's hard to do, but spread it out and make it less likely to incur the risk that you might see. So
that's one thing I'll just add to that one. I see that a lot when I review some individuals' 401k plans. A lot of companies offer their own stock within the plan. and I have seen heavy concentrations, or maybe the employer matches whatever the employee puts in with company stock. And I've seen allocations get very heavily weighted to company stock. And that exposes you to an additional risk, which is single stock exposure. So I think that's one example of where you want to watch diversification. Even if you really believe in your employer and your company, you need to protect your own assets and be mindful of that.
Absolutely, I agree. Because if that company goes belly up, guess what? All that stock goes belly up as well. So something to keep in mind.
Yeah, not only would you be out of a job, but your retirement savings is gone.
Right, exactly. There was another question. Go ahead.
Well, Joy, for example, a local company that had to go through bankruptcy.
Yep.
This was a couple of decades ago.
There was another question in the chat from Rachel. What percentage should we aim for in investing into our IRA or 401k again, taking into account the employer match? Again, it depends on what you can afford. If you can afford and you're able to put in 10%, and you get a 3 to 4% match, go for it. But if you can only afford to put in 4% and get a 4% match, you're still getting a match and you're still putting 4% of your paycheck aside pre-tax. So that's not a bad deal. It really just comes down to what's comfortable for you and your living situation, your expenditures.
Hi, Laura here. Last question from me. So my understanding, I work at Komatsu Joy, and they, allow us to, work with them to do a 401k, and they also offer a Roth. So is Roth, whenever you talk about pre-tax, post-tax, with Roth, that is pre-taxed. So they take the tax out now.
So it's
I guess just from my understanding of.
Yeah, so a Roth is post-tax. So basically the money has the taxes already taken out of it. So
Okay.
what that Roth component allows your money to do is grow tax-free. So as long as that account's open, that money's growing tax-free, and then you're able to take that money out without a tax on it. So it's a really nice feature for sure. If you have that option, it's something to definitely take advantage of if you can, for sure.
And wouldn't that be a benefit as well for, our audience here as young professionals, where I can at least speak for myself, I'm going to be in a lower tax bracket now. So that might be better for the tax to come out now than maybe later on in my career, when hopefully I might be in a higher,
You got it.
higher bracket.
Absolutely. Yep. Yeah. It's something I think that a lot of young people don't really truly understand the benefit of it. Anytime I talk to a young person at the office, I definitely try to encourage them to get into a Roth IRA if possible, because it's just the benefits of it long term are they're there. Put it that way. You don't want to miss out on it. So.
And then with that, then when should we switch to a different account type if we're getting close to retirement? Should we not put money into an IRA anymore? We should switch to a different type of account?
I guess it depends on your tax situation. If you end up, you're contributing 40 grand into a Roth IRA, and then you jump up into a higher tax bracket, at that point, you needed to get a tax deduction. So maybe at that point you start putting into a traditional IRA if you're not too old, and you take the tax deduction on top of the 401k tax deduction that you get. I guess I don't know if that answers your question, but that may be one instance of a timing where you might switch accounts to something a little bit different. Yeah,
it's tough to say, because it's really going to come down to what's your tax rate now versus what's your tax rate in retirement.
Right.
And so when you do retire and the paycheck goes away, then your tax rate is going to be lower then too. I think honestly, if it's good to have both.
Yeah, Absolutely.
oftentimes as advisors, we refer to Roth accounts or Roth dollars as your last dollars,
Yeah.
because that can continue to grow and you'll never pay taxes on it when you do that withdrawal. In retirement, we encourage you typically to touch those funds last, unless for some reason in retirement you need to do a significant withdrawal, and doing so out of a 401k or a traditional IRA might elevate your tax bracket, then maybe it makes sense. But in a general speaking, your Roth dollars are the last ones that you would touch because of the tax benefit.
I guess you could say it's the first ones you put in, the last ones you take out, in a way.
Well said.
Now, another question that some of us may run into, hopefully not, but I've often heard of people borrowing against their 401k. Any thoughts or comments on that?
I mean, if you can avoid it, avoid it. That the only thing you're doing there is you are, and I believe what happens is, unless you pay that back, if you were to leave that job, you can't roll that over until you pay back that loan. So, I mean, if you absolutely need it, there's certain situations where you are able to take it out: hardship withdrawal, disability, God forbid, but death. Those are situations where you potentially could take money out, first time home buyer. But a loan against it, that's basically the company lending you money on your based on your 401k. So you would either have to pay, I believe, the value out of that 401k before you leave that company and roll that money out of there. So you end up losing money on it unless you can pay it back over time. Same thing with an IRA. They're kind of similar in a way. I guess tax wise, if you take money out of an IRA, you got to pay taxes on it, but and there's a penalty for early withdrawal before 59 and a half. So there are situations though, however, you can take it out, pay the taxes on it, and avoid that penalty because of a first time home buyer, disability, hardship, etc.
So if you go through an organization, sorry, I promise this is the last question. So I guess depending on what organization you go through to set up a retirement account, I guess would that have anything to do with if you, let's say you're let go from a company, or you have to quit or something, are you able to roll that over to, I guess, just to yourself if you go to a new employer that does not offer like a 401k contribution? Or so you're able to take that money with you?
Correct. Yeah, you would just more than likely, unless you're, there's the option where you could roll it into your new employer's retirement plan. But the most common methodology is to roll it into an IRA. We see that a lot. We do that every day, basically, at least once a day. Yeah, that's very common, Laura. If you leave an employer, I think it's encouraged. I would encourage you to not just kind of let it hang out. Sometimes the fees that you would be paying are a little higher than you might see at an advisory firm, whether it be Northwest or Raymond James. And in addition to that, nobody's really managing it. So it could be in the toilet and you wouldn't even know. So it's definitely encouraged.
Okay, thank you.
Mhm.
Did anybody else have any other questions, any comments or anything? All right.
If not, I just have one last thing then. So again, Tom and Alex, just thinking of our demographic here, our young professionals, some are just starting out in their career, others have progressed a little bit in their career. What would you say if you could tell us one thing to do after we log off this call? what's one piece of advice that you really would want to make sure we all walk away with, thinking again of the young professionals group?
I mean, if it were me, I would say if you're not already contributing to an employer plan, find out if you have the option to. If you do not, I would encourage you to get involved with, whether it be Northwest or Raymond James, give somebody a call and say, hey, here's my situation. How can I get set up for retirement? Because I don't want to be behind the 8 ball come 40, 45.
I would agree with that. And, I thought there was value in all 7 habits so if I wouldn't take away just one, take away all 7.
Mm-hmm. Yeah, absolutely. I think, Laura, on the next slide, I think our information's on there. If anybody has any questions about anything, if we talked too fast in any of the habits and you want to review anything, please, don't hesitate to reach out to either one of us. We'd be more than happy to chat with you.
Awesome. Thank you, Alex. And thank you, Tom, very, very much for joining us tonight and speaking to these points. A lot of really great information, a lot of great conversation there at the end. So thank you all for your participation. Again, thank you, Alex and Tom. If there's no other additional questions or comments, I encourage everybody to take down their information and reach out if you do have any questions or anything to discuss with them in the future. Even if you don't think you have any questions right now, definitely just take a screenshot or a picture or something, and then reach out if you do have any questions in the future.
Absolutely. Thank you guys again for the opportunity. This has been it's been fun, actually. I don't know, I like to do this stuff. If I can help give out a little bit of knowledge, it's always fun. So
thank you all.
Great. Thank
Awesome.
you guys
Thank you.
so much.